This is Bloomberg Wall Street Week.
We may not have an overall recession, we're having a rolling recession. The economy overall looks pretty strong, at least when it comes to jobs.
The financial stories that shape our world.
3 major regional bank failures sent shockwaves through the banking system. We're all trying to figure out what to make of generative AI.
Through the eyes of the most influential voices.
Welcome now Dr. Paul Krugman, Brian Moynihan of Bank of America, Deborah Lair of the Paulson Institute, Glenn Hubbard of the Columbia Business School.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
War in Israel takes a pause. The world takes another shot at dealing with climate. And we say goodbye to 2 giants, one in diplomacy and the other in investment. This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers on the legacies of Henry Kissinger and Charlie Munger. Jean-Yves Fillon of BNP Paribas on what his clients are telling him.
Part of them are expecting actually to access capital markets at a later time when rates normalize.
And Joe Sitt of Thor Equities on the investment opportunities in Mexico.
We think this is another one of those golden opportunities where we're early.
Global Wall Street watched this week as Israel's war with Hamas went on a temporary hiatus as Israel stopped its military operations in a deal that brought some of the hostages home.
The approach that we're taking with Israel and quite frankly with our partners in the region is working. It's getting aid in to people that need it.
And Elon Musk used the opportunity to travel to the war zone to counter accusations that his post on X was anti-Semitic and to offer to help rebuild Gaza once things are over.
Those who are intent and motive must be neutralized. Then the propaganda must stop.
The world gathered in Dubai for COP28 in the latest efforts to get a move on in dealing with climate, with U.S. officials once again expressing hope.
I'm confident that COP will provide an opportunity both to identify the opportunities that this energy transition is providing and to build the broad international coalition.
Even as more than 70,000 delegates were talking about fossil fuels, OPEC Plus met in Vienna to review restrictions on oil production.
It could be simply that OPEC Plus decides to curtail supply and we get a Brent going back up to the low 90s as a result of that. It's a question of how much they curtail supply by, but that's the biggest risk right now. 2
towering figures on global Wall Street said goodbye this week. As America's foremost diplomat for a generation and more, Henry Kissinger left us at the age of 100. And Warren Buffett's longtime partner, Charlie Munger, passed away at age 99. On the economic front, the United States continued its strong performance with GDP growing at a robust 5.2% clip. And when you put that strong economic performance together with a Fed that seems to be signaling it may well be done with hiking, well, what you get are some pretty happy markets as the S&P 500 added another 0.8% to end the week at 4594, which is above where the Bloomberg elves, equities, and the analysts thought we would end up 2023. And by the way, above even where they think we're going to end up at the end of 2024, which is 4,500. The NASDAQ was up 0.4% for the week, while the yield on the 10-year was down nearly 26 basis points for the week to end at 4.21. For her perspective on these markets and what they are telling us about investing today, we welcome now Catherine Keating. She's BNY Mellon Global Head of Wealth Management. Catherine, welcome back. Great to have you back on Wall Street.
Great to be here, David. Thank you.
So let's start with some of those data. I mean, we got some really robust data that we talked about this week, but it's just the latest in quite a few series of data that are pretty encouraging with the economy.
Yeah, so the real story in markets has been the month of November, obviously, and the market's digesting really 4 pieces of important data. The first one, of course, inflation. Inflation continues to go down, but we see disinflation broadening. We see it in goods, we see it in services, and we see it in big ticket items like shelter and automobiles. So that's the first thing, inflation. Second thing, labor market softening a bit. That's a good sign for lower inflation as well. We see the unemployment rate drifting up a bit, 3.9%, still very low historically. Unemployment claims drifting up a bit. And then the real news, I think, was the following. The bond market digesting that huge move in 10-year Treasury rates in the month of November, 60 basis points down from a 488 down 60 to 428. That's an enormous move in financing costs, not just for the federal government, of course, but for anyone who borrows, consumers with mortgages and car loans, local governments, companies. Very big news. And then the last thing that the market was digesting is after 3 quarters in a row of negative earnings growth in the S&P 500. We actually had positive earnings this quarter. 4% growth, 80% of companies beating expectations. So the market digested all of that, and you said it, we had a rally at everything.
So I must say, I find this a little humbling, because if you go back to the end of 2022, I'm not sure we would have predicted any of this. So why did so many of us get this so wrong?
So, David, as you know, history has taught us that when you have inflation in the economy and you have the Federal Reserve raising interest rates to slow the economy, 90% of the time you end up in a recession. So here we are, we're 20 months in to a very fast and very aggressive Fed hiking cycle, and there's no recession in sight. Why is that? I think many people underappreciated the change in two pillars of the economy, consumers and large companies. Consumers, of course, 70% of the economy. The consumer balance sheet has changed dramatically since the financial crisis. First, consumers are twice as wealthy, 20% wealthier just since the beginning of this decade, thanks to stock markets and real estate appreciation. Second of all, they've been borrowing less. The financial crisis was a terrible crisis for the consumer. They've been borrowing much more prudently. You see, 10% or so of their disposable income now going to borrowing costs. That was close to 15% before the financial crisis. But the most important thing when you look at consumer balance sheets is 2/3 of consumer borrowing is their mortgage. Those mortgages have been refinanced at very low rates. They're going to stay that way for a while. Corporate America, sort of the same thing. Big companies, before the crisis, they would borrow in short-term markets, commercial paper. Those rates are very high now. Companies aren't doing that. Instead, they did what consumers did, and they took advantage of low rates in 2020 and 2021, the S&P 500, taking refinancing debt, issuing new debt at low rates and terming it. 4 years, 5 years, 6 years, 10 years. And so that has made both the consumer and large companies less sensitive to interest rate increase.
It's really great to have you back on. Thank you so much. That's Catherine Keating of BNY Mellon.
We have always thought of foreign policy and economic policy as something that has clear-cut terminal dates, and that you are either in a condition of conflict or in a condition of blissful peace. In the 90s, if we do it properly, we will live in a less dangerous world, but one which will never be totally without problems, and in which the subtlety of American statesmanship in adjusting the various balances, both political and economic, will be severely tested. But if we do it well, it could be an extraordinarily creative period.
Henry Kissinger defined the world of diplomacy for 2 generations, remaking the geopolitical map of Asia and the Middle East. A Jewish refugee who fled Nazi Germany for the United States, Kissinger returned as a U.S. Army private to serve in the Battle of the Bulge. After the war, Kissinger became Dr. Kissinger when he earned a PhD in political science and then joined the Harvard faculty. When Richard Nixon became president in 1969, he appointed Henry Kissinger as his national security advisor and used him to open a window to China that made the current economic miracle possible.
To most people in 1968-69, it seemed inconceivable that the US could have a relationship with such an extreme, zealous regime as Mao Zedong's. Remember, the Cultural Revolution was in full spate, and most people thought the regime was just nuts. So the very idea of trying to establish a relationship was a minority pursuit.
Kissinger also negotiated a peace treaty between Israel and Egypt and a ceasefire with Syria. That brought calm to a region that had been upended by wars since the end of World War II. Kissinger also played the lead role in negotiating an end to the United States' involvement in the conflict in Vietnam, which earned him the Nobel Peace Prize in 1973. Dr. Kissinger's role in the world was not without controversy. He was accused of pursuing an illegal military offensive in Laos and Cambodia, as well as playing a role in coups in Chile and Argentina that resulted in repressive regimes.
And this is the thing that critics of Henry Kissinger have always struggled with. They've been very bad at setting the crimes of apprenticeship in the context of the Cold War. When you see it in the context of the Cold War, you realize that the war crimes, the crimes against humanity being perpetrated by communist regimes were on a much larger scale than those that were perpetrated by regimes of the right. And this is really the important thing one has to bear in mind. Henry Kissinger said even before he went into government that foreign policy was very often a choice between evils, and the job was to try to choose the lesser evil.
Every president since Nixon turned to Henry Kissinger for advice on foreign policy. He was the author of influential books, from his first on Europe in the wake of Napoleon, published in 1957, up to Leadership, 6 studies in world strategies, published last year. Just last month, Henry Kissinger appeared to give a speech at the annual Al Smith dinner in New York. At the end of that speech, he said, quote, "A great leader is the giver and protector of our hopes." Henry Kissinger, dead at age 100. Coming up, we turn to our special contributor, Larry Summers of Harvard, for his thoughts on the lives and legacies of 2 towering figures, Henry Kissinger and Charlie Munger. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. We welcome now our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. Larry, thank you so much for being with us here in New York. It has been quite a week where we lost Charlie Munger, we lost Henry Kissinger, and then on Friday we actually lost Sandra Day O'Connor as well. I know you knew Henry well, you knew Charlie Munger. Talk about Henry Kissinger in your experience.
He was an extraordinary man. It was extraordinary to see somebody in their 80s and then in their 90s and then 100 years old, so incredibly intellectually vital, looking to learn about AI, speaking to most of the world's leading statesmen every several months. He was fully engaged and active in the way that many people half his age wouldn't have had the energy and the drive to do. He was somebody who always thought in the large first, understanding the broad historical forces that were shaping relationships between countries, from that forming a conception of strategy, from that conception of strategy working to tactics. It was anything but the day-to-day political thrust of statements that so often seems to preoccupy leaders these days. He surely didn't get everything right, but he certainly was always trying to reason from the large to reason down. And I learned from his deeply, in a way, tragic sensibility. He was the idealist as realist. He and the realist as idealist. Henry, maybe because of how and where he grew up in Germany in the 1930s, feared disorder, feared chaos, feared the complete triumph of passion over reason, and his determination was to bring about stability, not because he somehow thought that the pride of nations and strength was what was most important, but because when there was the containment of evil, that was when people had an opportunity to live and flourish.
The partner of Warren Buffett, important. What effect did he have on investing writ large?
You know, I think the first thing to say is that Charlie and Henry had something very important in common. They had different interests, they had different styles, they had different ways of speaking. But they both had a deep commitment to seeing the world as it was, not as they wanted it to be. And they began by trying to see things as realistically, as clinically accurately as possible. And that was the basis for decision, whether it was political and diplomatic decision in Henry's case, whether it was financial and investment decision in Charlie's case. What I got from both of them was this commitment to detached observation as a prelude to taking action. You know, by Warren's testimony, Charlie provided a really extraordinary insight. He said, and it's different than the old-fashioned and traditional value investing credo, Charlie rejected the idea of buying fair companies at great prices. He thought you'd ultimately do better buying great companies at fair prices. And that philosophy of finding the best, making sure you weren't overpaying, and then sticking with it is one that has certainly served him and certainly served Warren well. But I saw it. Charlie was an involved alum of Harvard Law School while I was the president of Harvard. And he had a view. It was clear. There was a logic. He was prepared to argue and defend it. He, too, was an extraordinary figure. And you have to also look at both Henry and Charlie and see the power of staying curious. They stayed with it to the very end. And I think their curiosity, their love of reading, their love of discussion, their love of argument was part of what caused them to flourish for so very long.
Well, it may be a reach, but I think you're really emulating that in staying curious as you've now taken this role with OpenAI. You talk about Henry Kissinger with OpenAI, you're taking it on. Let me ask you, frankly, why did you take the job and what do you hope to do with it?
I thought that, as I said on your show, that this was something that was extraordinarily important. You know, no one can be certain whether this is a once-a-decade technology, a once-a-half-century technology, a once-a-century technology, a once-a-millennium technology. No one can know that for sure, but it sure looks like it's awfully important to develop rapidly and safely and to disseminate effectively and well. So when I was offered an opportunity to be part of contributing to that and overseeing to make sure that that was effectively done and to do it working with some very great people, I thought it was a real opportunity and I was glad to do it.
I don't want to take anything away from your technological expertise, but what you just said, safely, strikes me as probably part of what you're going to be focused on. And that gets to questions of governance, about how you handle this technology, wherever it's going and however powerful it may be. Do you have an overall sense of what you need to do to govern it to get the safely part right?
You know, David, I've been on the job 2 days, and they're going to send me the onboarding packet for the board on Sunday. So I shouldn't be saying too much at all because I don't know enough. Here's some things I think I know. I think I know that a company like this has to be prepared to cooperate. Doesn't mean always agree with, but cooperate with key government officials on regulatory issues, on national security issues, on development of technology issues. I think I know also, and this is integral to the structure of OpenAI, where the for-profit entity is itself a creature of a not-for-profit entity, that this needs to be a corporation with a conscience, and that we need to be always thinking about the multiple stakeholders in the development of this technology. And as a board member, that will be part of my responsibility, working with other board members to make that certain. You know, my colleague at Harvard, late colleague Ken Galbraith, said that conscience is the knowledge that someone is watching. And I think it's the responsibility for everybody involved in this to be thinking very carefully always about both opportunities and uncertainties, and to make sure that those are balanced in the best way that's possible.
Larry, it's really great to have you with us, as it always is. That is our very special contributor, Larry Summers of Harvard. And this is Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Supply chains. Until the pandemic struck, most of us gave them little thought, apart from those working in shipping and procurement. But then we were hit with the reality that critical supplies for healthcare and much more came from one country, China, presenting the need to diversify.
These supply chains are complicated. Your viewers know this from the business world that, look, the semiconductor value chain, it stretches across the globe and goes around at least 3 times.
Now companies and countries are moving quickly to reinforce and diversify their supply chains, with President Biden this week announcing a White House Council on Supply Chain Resilience.
Let me be clear. Any corporation that's not brought their prices back down, even as inflation has come down, even as supply chains have been rebuilt, it's time to stop the price gouging.
And with the new emphasis on alternative suppliers comes the movement of capital and investment, creating investment alternatives to China.
I think some of the emerging markets outside of China have done relatively well. These include places like India, include places like Indonesia, Mexico, Brazil, and even some places in Eastern Europe like Greece and even Poland. These countries have done well. Still relatively small to absorb too much capital, but you can see that this sort of new era is beginning. It takes a while.
One of the beneficiaries is Mexico, whether it's in trade.
The main issue with China is exports. They've declined significantly in terms of what they export to the U.S. over the last 5 years. And that, I think until they can turn that around, that's going to be an issue. And there's other countries that are benefiting from this, like Mexico with its nearshoring.
Or in real estate.
I would say there's great opportunity is in Mexico in the industrial space, and particularly along the border. And you have a lot of multinational companies that are located there looking for logistics and distribution type space.
Or in manufacturing.
There are going to be markets that kind of in Mexico where, you know, more things are being made there again, and some of the restrictions that have been applied to China have benefited the Mexican economy.
Putting Mexico high on Jamie Dimon's list of investment opportunities.
We've doubled or tripled our capital here in the last 6 years. We cover more clients in private banking, investment banking, asset management. So our commitment is total. I think it's one of the great opportunities. I'd put Mexico, you know, if you had to pick a country, this might be the #1 opportunity.
To give us the investor's perspective on Mexico, we welcome now Joseph Sitt. He's founder and chairman of Thor Equities, whose Thor urban unit is the largest real estate developer in Mexico. So, Joe, thank you so much for being here. It's great to have you. First of all, give us a sense of just how big you are in Mexico.
In terms of the company, we're probably the largest individual developer in the retail asset class and the hospitality asset class, and then because we're in so many things from industrial, manufacturing, condominiums, et cetera, we're probably top 2, top 3 developer in the country today.
So why are you there?
Opportunity, and I would call it both opportunity, growth, and alternative. When you think of the world and how things are changing, Mexico is becoming quite the answer to some of the United States' economic problems. And by being that solution, it's been wonderful for them. As a country, I would say it's 4 things that really make up their economy, their drive. One is their local specialty assets, I call it. It's avocados, it's tequila, and it's beer. We know it as, you know, going out and having that drink of beer and having the dip and the tequila, et cetera, but it really is a product that's been growing. I mean, if you think of tequila, 30 years ago, did you really go to a bar and hear a friend order a tequila? Not really. And so Mexican culture has gone global, it's gone viral. Sort of what happened to sushi 40 or 50 years ago happened in Mexico. And then the second thing is remittances. You know, a lot of Mexicans and Americans, because of the close relationship between our countries, really transverse back and forth. And then probably the thing that's been the buzzword for the last 30 or 60 days is nearshoring. You know, we, as a country, we see the world sort of bifurcating, multipolar conflict. Mexico's a great solution. It's right here in our backyard. It's easy. Labor is actually cheaper than labor is in China. The people are hardworking, they're industrious. The commuting point, the logistics for a container ship is free relative to shipping it from China. And so it's really become the Chinese alternative.
So Joe, you've described an investment opportunity, a big investment opportunity in Mexico. Typically, there's an opportunity, money rushes in, capital rushes in, and it becomes fully priced. Where are we in that cycle? How close are we to fully pricing the assets in Mexico so it's not quite the deal it was before?
Excellent question. And often people generalize by the country, but you've got to also look at the specifics, meaning by the asset classes. For example, nearshoring, you had 120 companies announce investments in Mexico so far the first half of this year, about $29 billion in US dollar investment, a 41% increase from last year. Based upon the early research, it's looking like next year is going to double on that. So I would say from the industrial opportunity, I think we're in the very, very early innings of it, probably the earliest innings amongst the different food groups. In fact, one of the things I've often bumped into my challenges with investors, as well as sometimes, as we said, the media, is we're often at Thor sometimes a little bit too early. We don't try to be the first. As I often say, we try to be the fastest second, but it's not until you're the third or fourth or fifth that the investors get it. And same thing happened with us in investing in Dubai, as you and I had spoken about, 4 years ago. Same thing happened to us talking about red states versus the blue states and investing in red states 15 years ago. And we think this is another one of those golden opportunities where we're early. We're just in the beginning of the second inning with a lot of runway. And those investors that act quickly now to mine that opportunity will get that benefit. If they wait, call it 3 years or 4 years or 5 years, then it starts getting priced in. I would say retail is probably already priced in, and I would say condominiums, second home, tourism while growing is probably somewhere in the middle there. So I would say ahead of the curve is industrial, probably already valued well is retail, and as I often joke, forgive the expression to my team, I say ride the horses, feed the lions and shoot the dogs. I would call the office market there probably the dog, and I would say the industrial market is probably the lion.
Joe, you're clearly bullish on Mexico's investment opportunity. Compare it with some alternatives. We had Steve Schwartzman just this week say he thought when it came to real estate, Europe was a great opportunity right now. How do you compare Mexico with Europe with some Asian alternatives?
Well, Steve is a friend. I'm a fan of him and John Gray, both super smart guys. We often compare notes and look at ourselves as a miniature version thematic investor that then develops specialties in different areas. So I don't doubt what he's saying. We've got an office in most of the major metropolitan cities inside of Europe, very active market for us. But I would say a lot of the early low-hanging fruit in Europe has been mined, but where the opportunity in Europe is much more because of the dislocation because of financial markets.
So Joe, what about geopolitics, and particularly politics when it comes to Mexico? That's often been an issue for investors. We have an election coming up. Where does that stand today?
You know, when AMLO was going through his election cycle, it scared the bejeebies out of local players and candidly myself. AMLO then came in and he sounded good. He was a good hearer of what people were saying, but wasn't a good listener, I'm sorry to say. And so I really think that Mexico did well in spite of itself. Now, the politics is much better. Either way, we're getting a woman for the first time as the president of Mexico. It'll either be Claudia Sheinbaum or it'll be Xochitl Galvez. Both of them pro-business, listeners, touching their communities and really caring about their constituents at all levels, and not just considering rhetoric to be the answer. They're thoughtful about the jobs, et cetera. So I would say that's probably my overall number one most exciting thing today that I'm excited about the future of Mexico for the business community.
Joe, thank you so much for being on Wall Street Week. I hope you come back. This is great. That is Joe Sitt of Thor Equities. Coming up, telling the difference between what's fake and what's not, with or without artificial intelligence. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Authentic. The Merriam-Webster dictionary defines it as worthy of acceptance or belief as conforming to or based on fact. And Merriam-Webster has also deemed it to be the word of the year, explaining that the line between real and fake has become increasingly blurred, which may just be the understatement of the year. Certainly some in the tech community seem to be struggling with the difference. Sponsors canceled a software developer conference this week after speakers' profiles on the website turned out to be fake, leading several tech executives to pull out, including one from Microsoft who posted that he had been duped by the fake speakers.
There was a lot of concern that there was a plot to make the account to make the conference look more diverse than it really was.
The once vaunted Sports Illustrated took down articles from its site after allegations it had used artificial intelligence not only to write the stories, but also to credit them to fictitious reporters complete with profiles, something SI's parent company denies but says it is investigating, further blurring that line between the authentic and the fake. But all of that is nothing compared with the current poster child for confusing fact with fiction, Congressman George Santos from Long Island. Representative Santos continues to claim that life is treating him unfairly even after an indictment and a move by his colleagues to expel him from the House of Representatives for making up more things than we have time to go through.
Pursuant to Article 1, Section 5, Clause 2 of the Constitution of the United States, Representative George Santos be, and he hereby is, expelled from the House of Representatives.
In the world of business, Elon Musk certainly has his work cut out for him, sorting through over 100 million posts on his X social media site to separate what's true from what's not, and for that matter, what's just downright malicious. But for Musk, right now, the problem isn't so much what's false as what is undeniably true, like the fact that he reposted something that much of the world regarded as anti-Semitic, which triggered advertisers like Apple, Disney, and IBM to pull their money from the site.
This company, X, Twitter, has spent months basically doing damage control over Elon Musk's post.
Apparently, as a make-good, Mr. Musk traveled to a war zone this week and offered to help rebuild Gaza once the fighting has stopped.
Those who are intent and motive must be neutralized. Then the propaganda must stop.
Well, I hope you'll be involved in it. And
I'd love to help.
As Mr. Musk struggled to deal with how he's marketing X, another business leader took a very different approach. One of the great brand builders of our time, Martha Stewart, has, of course, made a series of TV commercials with Snoop Dogg.
Do I smell? That's right. Fondue time.
And then posed for the cover of the Sports Illustrated swimsuit edition at the age of 81. Now, Ms. Stewart has taken yet another step to keep her profile high, this time by offering a stay at a two-bedroom cottage on her estate in Bedford, New York through Airbnb, complete with a brunch with Martha herself, all at the bargain basement price of $11.23. Talk about marketing. The world was reminded this week of just what the word authentic really means when it comes to investing with the passing of Charlie Munger at the age of 99. As the longtime partner of Warren Buffett, Charlie made money for Berkshire Hathaway shareholders the old-fashioned way. He earned it by doing his homework, making a few big decisions and staying with them. And in the process, made historic returns. When it comes to Charlie Munger and Warren Buffett, there was no fiction. It was all fact.
I think I fixed one flaw in my life. I got over having tantrums when I was about 4 or 5. But every other flaw I haven't fixed. I've just counterbalanced it with offsetting virtues.
That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.